So I'll continue in the section of futures trading. Let me just fast forward. Okay. Yeah, I think it's there.
Current profit and what is P and L, what is cross margin and isolated margin. Then I will talk about order by quantity, order by costs, order by cost, limit by order, limit or market by order, limit or market sale order. After I'm done with all these topics, then I will now do a video to explain how it looks on the exchange. Now, first and foremost, I want to talk about what is P and L or profit and loss. The moment you are trading, the current profit and loss that you are on, the exchange will be showing it every second, every minute. So it is the we call it P and L. It is called unrealized, or I can even use the word unrealized P and L. It's until they either you close the trade by yourself manually or the exchange close for you depending on the trigger price you gave that exchange, then you will now be able to actualize the profit. Your balance will now increase. So the loss is still unrealized until whether you are liquidated or you did stop loss, part of your balance was you call loss. But, but at the time the trade is still running, it is still called unrealized P and L. If you go here, this is an example of a trade that's ongoing. You are seeing here the roads unrealized P and L, and this the trade is down by minus 26.51% because okay, let me now this is a trade I'm currently on. This is the unrealized P and L. Unrealized P and L. Consider it is negative minus 0.94 because currently the return on investment or return profit is down. The coin is down. But this is my entry price 1.1112 and this is the current price. So the coin has gone down from my entry price. So it's down by minus 26% because of my size. You know, I have just this is my margin. I have only $3.56 that is in the trade, but because I use a leverage of 70, so you multiply 70 times 3.8, it will give me 2.49. So I'm not going there. I will explain this one later. What I'm talking about is unrealized P and L. So it is unrealized. It is there. I'm still 0.94. It does not mean I have incurred the loss. It's until they close. If I close by myself here, I can incur or realize this loss. But as the trade is still running, because I have a target, then it is still unrealized. So it was unrealized. So if I close the trade now, then I will realize that L loss. But if I close the trade in green, if this one is plus 26.5 green, it's green not red, here it will be $0.95. So when I now close it all, the trade closes it by the trigger price I told the exchange, then I'll be able to realize this profit. So that is unrealized P and L. I want to explain about that. Now, let me talk about the next topic I want to talk about is um, what is cross and isolated margin. That is a very important topic. Cross, all these things, it took me years, it took me months, and isolated margin. So I don't have any fear for trading in futures again because when you understand the fund and risk management, the fear of loss will not be there. The moment you have a good entry point, entry price, you have very good fund and risk management, then you are good to go. Now, We have two types of margin in futures trading called cross and isolated margin. When I traded, I paid for the tutorial for this thing. I think was it not in year 2023 in January. I paid a lady to teach me futures. It didn't make any sense to me. The way the lady was even explaining it, it didn't make any sense. But now I have some level of understanding now. Now, let us talk about cross margin. It's cross or isolated margin. So cross margin is, let's say you have $30, your total capital, and you are just committing just 10% of your entire capital into the trade, $3 into the trade. Now, if you want to go for cross margin means that you want a strategy mode, a trade mode on the exchange whereby you want to use your remaining balance, which is $27, as your backup. I'll call it backup, or like a collateral to make you to be able to stay long in a trade. The only money you put in the trade was $3, and you have $27 as balance. $27 will now stand like a collateral or like a backup, like a shock absorber. So that when the coin is going up and down, you'll be seeing that this $27 will be reducing. If the value of the coin is going down, this balance will be reducing to 26. If you go down further to 25. So this balance is what is you are using as a backup for that trade, that is able to make you to stay longer in that trade. That's why using just 5 to 10% of your capital is very, very important. This is one of the first risk management. So when you want to do cross margin, I want to use cross.
Let me correct that, please. When you want to start doing futures trading, you can't use, that was one of my errors. So I need to correct that, please. Using 5% to 10% is too high. 5% to 10% of your capital is too high. And in that video, I was showing us that I was doing a leverage, using a leverage of 70x is too high. So those are the reasons why I was liquidated, because using high leverage was giving more profit, but it's more risky. It will make you to be very close to the price that you'll be liquidated. So using 2% to 5% of your capital is safer, and using a leverage of 10x to 30x is better. It's better you are making little gain, little profit sustainably for a long time than being greedy. You want to make so much profit and you get liquidated. So I want to correct that, place.
Margin to trade future, whether long or short position, and you want the remaining backup to serve as your collateral that will back it up in that way that you know you stay longer in a trade before it closes because of stop loss or if the market going against you. So if you use cross margin, it will make you to stay longer in a trade. I hope that is clear. Now let me talk about isolated margin. Isolated margin. If I use isolated margin to trade futures, isolated, you have $30, you want to use $3 to enter that trade. In this one, you are not using the remaining $27 as your backup. You are telling the exchange that the moment my profit and loss value is more than $3, it's about to get more than $3, just cut off my $3 and end the trade. That means you are not depending on the balance of $7 to back up your trade. You want the agent to close your trade the moment the depreciation value of the P&L is more than $3. then instead of you losing, whether you stop loss, instead of you clearing your, maybe out of the $30 you clear $20 from your money, or the entire money you lose it, you want to bear the loss of only $3. Let me give you an example like this screenshot. Now the money inside this trade is $3.56 out of, I think, $38. Now if you are doing isolated margin mode, the moment this your unrealized P and L is equal to 3.56, you want the trade to close. The trade will just close. It will close. Then it's not a very good way of trading futures, because the coin can easily go further down negatively, and then your unrealized profit and loss, or unrealized loss, is equal to this. Then you will be kicked out of the market from that position, from that trade, if you are using isolated margin. So I don't use it. I don't use unrealized. I don't use isolated margin to trade. Already spoken about cross margin and isolated margin. Let me just give us how this thing was calculated. You can see that the ROI here is minus 26.5. This is your margin. How did we get this? If you do 26.5 of 3.56, it will give you 0.9434. That's why we are seeing this value here. So just imagine this goes to 200% up. That's where the money is. It goes to 200. That's why you see some screenshots. You see 460%, 200%. It's because of the leverage that you use. That high leverage will increase your profits, return on investment. So let's say this one is 200% positive. If you now do 200% of that, your margin, that's how you'll be able to get $7.12. So don't let me go too fast. I'm still going to that topic. So I've already spoken about cross and isolated matching. Now let's talk about. So before we talk about the next other points, that isolated margin has a disadvantage, in the sense that the moment the unrealized P and L is equal to your margin or more, it will close that trade, and what you only be losing is that $3.56 margin, and it will close the trade. And if after you close the trade, the coin now started going in the right direction that you expected, and you're supposed to make profit, then you have already been kicked out from the trade. That's why using cross margin trading mode is much more better. So let's continue. Order by quantity. Yes, this is very important. Now, when you want to enter a trade, like and this coin now, this current coin I'm trading, the current price, let's say that the current price is 1.107. That means the one quantity of this coin called WIF. This is an example, please, an example. One quantity WIF, I'm using WIF as an example. The current price is $1.1. One of it is $1.1. I'm talking about order by quantity. Coming. Order, if you want to place your order by quantity, whether you want to place a long position or a short position, and you want to place your order by the quantity of that coin. Now, if you want to order by quantity, let's say WIF, current price is 1.1.1. If you want to order by quantity, let's say you want to order $4 worth, of this 1.1. The 1 unit of WIF is $1.1, and you want to order it by quantity. Place the order by quantity. So what will you do? Let's say you want to order maybe 5 units of this width. So 5 units of this width. 5. 1 is 1.1. 1 of current price of that width is 1.1. So if you want to order 5 quantity of width, that means the total value will now be what? $5.5. Quantity, the total quantity is 5, and 1 quantity of width is 1.1. So if you want to order it by quantity, then when you are placing your order, you just type 5. But when you want to place order by cost, when I'm doing this thing practically, you understand better. Let's say you want to order by cost, by cost. Order. I don't want this video to be more than 15 minutes. I want to order by cost. So when you want to place your order, you don't want to order by quantity. You don't want to be doing calculation here and there. You don't know mathematics. You can't multiply simple 5 times how many quantities you want to place. Just type the dollar value. Out of my $30, I just want to buy $4 worth of that coin. Then the exchange will give you the quantity it will give you. So that is a very straightforward explanation of order by cost. Now let me talk about limit and market order. Limit and buy, limit and market. Limit and market buy order. Limit stroke buy order. I mean, you want to, that means this limit or market buy order or market buy order means, let's say you want to take a long position, you want to buy a coin that is down, you want to buy it from the bottom, you want to long it. Now let's talk about market buy order. Market buy order. That means the moment you want to place that trade, you want to buy it, you want to long it, you want to buy it, then let's say the current price is $3. You want to buy it at this market price immediately. That's what we call market order, market buy order. But if you want to buy using limit order, that means you don't want to buy at the current price. Let's say the current price is $3, but you want to tell the exchange to buy it maybe at a lower price of $2.5. Anyway, we are taking buy position. You can't expect to buy at higher price of 3.5. Does not make sense. You can only do that if you are doing short. But if you want to buy with limit order, you are not buying at current price, you want to buy lower, then you now put the price, lower price you want the exchange to buy it for you. So the moment the coin gets to that lower price, that's the limit order, it will pick up the coin and buy it for you. Now, what do we now mean by limit? That's the opposite. Limit or market sell order. This also apply to spot trading too. Then you saw a coin at $3. Now, if you want to buy, you want to take a short position immediately, that means you are going to place a market sell order at this current price. You enter immediately at this current price. That is market sell order. Market sell order. You want to place the order at the current price if you are taking short position, knowing that the coin is going to go down. But if you want to take a limit sell order, that means you believe that the coin might go higher first, so like 3.5 before it start going down. So when you place a limit sell order, that's what we call limit sell order. We are not buying. We are not that we are not buying. You are not placing a sell order at the current price you are seeing. You believe that the coin will go further
Okay, let me clarify that place. What I'm trying to explain that place is that when you want to place, the term that they use in futures trading is called short position. If you want to place a short position, a limit short position, that means you know that this coin is already pumped, it's already gone up, and you want to enter at a limit price. That means, let's say the current price is $3, and you don't want to enter immediately at the current market price. So you have done your analysis that this coin might first go up first before start coming down, because the higher price order, the higher price, the price that is higher than the current market price, when you enter it at an higher price, you now short it, you now place a short position from that higher price, you get more profits. You get more profit. So that's the difference between current market price short position and limit price short position.
up up first. You want to place it at an higher price, then when it's going down, you make profit. This video is already long. So this is a video that has explained a lot of things. I've explained what is P and L, what is cross and margin, associated margin, order by quantity, order by cost, limit and market by order, limit and market sell order. So in the next video, I'll be talking about fund and risk management in futures trading, how to calculate profit margin in futures trading. So we'll move to the next video to learn about that. Thank you. Use 5% to 10%. So in this video, I want to talk about fund and risk management in futures trading. Is very, very important. I've been talking about this in one way or the other since we started this course. Now, I want to talk about how we can do fund and risk management so that you don't lose money in futures trading, so that you can either not lose money or minimize loss. So number one thing you need to do is when you want to enter any trade, let's say you have $50. No matter what, it's just an example, whether you're using $500, $1,000, whatever you are using, always use five. That's the number one rule. Always use 5% to 10% of.
That rule is wrong. The current rule is for you to use 2% to 5%. Because I have to be correcting this error. This was the error I made in the beginning. 5 to 10%, although you can actually use 5% to 10%, 10%, 5 to 10% of your fund only if you are using a low leverage. If you want to use 5% to 10% of your capital, then lower your leverage. Then be using a leverage of maybe 10x to 15x or 20x. Don't ever increase your leverage if you want to use more of your margin. If you want to use more margin, you want to use more percentage of your capital. I want to correct that, please.
Your lower the amount of money you are putting to that trade as your margin from your entire capital, the better for you. Number one rule, always take 5% to 10%, or if you want to take more risk because you want to make more money, as high as 15%.
No, 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 no,
But don't pass it,
no,
please.
no, no.
5 to 10%. That's number one rule. Fund management and risk management. Then number two, don't be greedy. Don't be greedy. Don't overtrade. If you know that all the money that you have is $30, $50, because the first rule is to use 5% to 10%. Don't overtrade. Don't overtrade. What do I mean by overtrade? That means open multiple long position, short position, opening long opening many coins, and you just want to make more profit. They send one signal, you want to enter that signal. Send another one to send that signal. On the little money that you have, you will surely be liquidated. You will surely lose all your money. You should surely lose all your money. If you remember when I was talking about cross margin and associated margin, that with cross margin, your balance that remains is what will be helping you to be absorbing the shock of the volatility of that coin as it's going up and down. But the remaining balance is what the exchange will be using to back you up to stay longer than the trade before, so that the trade will not trade. You will not be liquidated in that trade. So don't ever over trade, please. Don't over trade. Now, also don't enter many coins. Also, always put stop loss. But for me, if I've done my because I've lost so much money using stop loss. But if you are just starting for the first time, always use stop loss, so that in case the market goes against you, you have $50, you've already put $5 in the coin, and the coin is going down, going down, going down, and because as the coin is going up and down, in your balance, and let's talk about that. In your balance, you see that this $50 will be going down, up and down, up and down. $51, it will go down to 49, it will go to 53, it will go to 47. It can even be going down to 49, 47, 48, 40, 35. You become scared and money is disappearing because the trade is still ongoing. It's when the trade now end, maybe on that $5 margin, you now make $12 on top. You now see that your money will now increase to, let's say, $62. So instead of you losing your entire money, so when you use stop loss, out of that $50, maybe you can lose $35, depending on the strategy you used to trade, whether depending on the cross margin, depending on the leverage you used. Depending on the leverage you use, because the higher the leverage, the higher the risk. The higher the leverage, the closer you be to the liquidation price. So the higher leverage, higher reward, higher profit, and the higher leverage, you make the liquidity price, the price that the coin, the price that the coin will get to, that make it to lose your entire money. So instead of you getting that price where all your entire money will be liquidated, apply stop loss so that you just lose amount. The remaining, if you even remain $15, you can recover this loss back. If you enter good 1, 2, 3, 4, 5, you can recover all the money back. You can recover the money back. So those are the things I want to talk about. Number one, use 5 to 10% of your trade, of your capital.
2% to 5%.
Endeavor that you don't over trade. Number two, endeavor to use stop loss. Number four, continue to add more money to your capital. Continue to add more money. Let's say continue to add more money, because this is what I discovered, that one of the ways you can manage your fund and use risk management is that, let's say we have $50 used to enter a coin. You now use $5 out of it. Then as you enter the trade and the coin is now, the P&L is now increasing, the negative is increasing, and your balance is now reducing. No, you use $5 to trade, you remain $45 as a backup. This $45, when the coin is going down, let's say you are in a long position, you see your remaining balance going down more, because the P&L is depreciating more, as in the negative is going down. Your return on investment, your ROI, is getting more negative, more negative, more negative. If the coin is going down, you have to see that your balance will be reducing. 44, 43, 40, 40, 30. It will be depreciating. It can go up again, it will go down again. So if you don't want, if you want to stay longer in a trade, if you have extra money to this $50, to this $45 balance, even if you have extra $10, $20, the moment you add more money, the liquidity price will be good, it will go further down. Let me explain what I mean. That's why using small percentage of your capital is very important. Let's say you enter a coin, you have 50. Let's say this is you enter a coin at $3. you want to take profits when the coin gets to $3.5. And the exchange tell you that the moment this coin gets to $1.5, you'll be liquidated. You now put your stop loss at, let's say, 2.1, that before it gets here and listen all my money. So let's say you start with $50, you put $5 in the trade, it remain $5, it remains $45. Now, this is a very good fund and risk, especially this risk management. Now, this is your entry price. This is where your stop loss is 2.1. You want to close this trade at 3.5. Now, this is your liquidate price. That if the coin gets 1.5, all your entire $50 will go. So instead of because it happens a lot, if there is a spike and the coin just spike and touches to $2.1, it will tell you how much you lose, and even lose maybe like $25 or $30 from your balance. So you don't lose everything if it doesn't reach 1.5. But one of the ways you can increase you can make your liquidity price where the price at which the coin as will reach and you be liquidated. If you want the liquidity price to go further down to, like, let's say $0.8, what should you do? Add more money to your $45. The moment you add, let's say $10 to your remaining balance that's not in the trade, you see that your liquidity price will change to go further down. If you add more money, it will be going to further down, so that it will sustain you in that trade longer, so that you will not be kicked out of the trade. And if it's you took a short position, you enter a trade at $3, and you want to sell the coin. You enter a short position from up, that when the coin goes down, you want to take like 6% profit, and but the market now goes against you. The exchange now said that if this coin gets to $4.5 up, if you reach here, that you will be liquidated, but your entire $50 will be removed from the exchange. So if you want the price at which you will be liquidated to go further up, add more money to your remaining balance that is not in the trade. It will be able to have it will minimize your risk in that, so that you'll be able to wait longer before the trade ends. And I want you to tell us that as a newbie, don't have the expectation that every you'll be getting signal. Every day your coin will be delivering, your trade will be delivering and be closing to give you profit. No, you can enter a trade 1 or 2 times in a day. You can enter a trade, it might take hours, some can take 24 hours, 48 hours, some can take days, some can take weeks, some can take a month before you get to your trigger price. So, but if you do a very good analysis, then the time at which your trade will be closed will not be too long. So I've explained fund and risk management. Now I want to talk about how to take profits, how to calculate profit margin, how to take profit margin calculation in future trading. Profit margin calculation. If you want to know your expected profits, or even the moment you place the order, the exchange will give you the profit it will give you. So let me give an example. This is just a general example to first explain first. Now let's say you enter a coin and your margin in that trade was $3. When this trade ended, I know the ROI very high. That's what makes trading very attractive. What you will get, you put $3 in that trade as your margin out of $30, and the trade now close with this 480%. If you go to your calculator, what will you get? 486%. Coming. 480% of $3, you are going to get 14.58 profit. That's amazing. Then you now say your $30 will increase to what? 14 to $44. That's what make spot trading very lucrative, very rewarding and profitable than spot trading. You can't use $2 in spot trading and get this kind of profit. It is not possible unless you buy a coin and you want to load it for long until it will do that 496%. Now, how do you now calculate your profit margin? Okay, you want to forecast what you want to profit. You want to forecast your profits. Maybe you have a target that in 30 days, this amount of money I want to make. Now, let's say you enter a coin at $3, and I want this coin to close. Let's say you did a long position, you bought it at the bottom, and when the coin goes up by 6%, you want the trade to close. 6% on the trade to close, and on the exchange, and you are using $4 margin that you put into that trade, and you use a leverage of 75x. How do you calculate the profit you make on this $4? It's just a speculation that I've seen it works most times. Now, the leverage you use is for 75x. Your profit margin from $3 to $33.5. That means the coin went up by 6%. Multiply 75 by 6. What will it give you? 75 times 6. That's 450. That's where you see this 470%. So 450% is what? Of that $4. That's how you make $18. I've made this kind of profit before. $18. Now imagine you have $40 in that trade. You are making a whole $180 as profit. Remove it from your margin that you used to trade. You are making a whole net profit of $140. So that's how you can calculate your profits. If you want to know, okay, if I enter this trade, how much will I make from this trade? But sometimes the exchange will actually tell you how much you make. This was a simple calculation on how you can calculate your profits. So I want to end this video here. So in the next video, I will now go to the exchange to explain some of these terms live on the exchange. So we'll move to.
Okay, wow. We discovered that I have made a lot of points in this video, and don't mind me the way I talk. Sometimes I'll be talking very fast. You might need to go and reward those videos very well to be able to understand a lot of information that I share in that video. That's why you see that to start trading, to engage in real trading, it requires a lot of knowledge and skill. So I want us to stop here tonight. If you have any question or what I've said so far, I've said so many things. So you can ask your question, please, if you have any questions. If you have any question, just type your question in the chat box, or you can unmute your mic to ask your question.